you want me to continue on this? Because I don't want to bore anybody.
This is interesting. You're taking a concrete guy to school here.
Okay, well,
I got to listen.
Okay, any questions?
This is interesting.
Stop me, because
well, I'm following. I'm following so far.
Okay, because I nerd out.
All right, welcome back to the Mac podcast, where we talk everything about entrepreneurship, business, real estate, everything that can challenge like the conventional thinking. And, I got a special guest today because I feel like he literally challenges conventional thinking in every way. He's got a Warren Buffett model that is always inspiring to listen to. He's 29 years old, multimillionaire CEO and majority owner of Abernathey Holdings. It's a holding company that actually owns businesses and real estate, specifically storage. So, guys, just another guy proving that it can be done at an early age. Andrew, thank you for letting you host us in our hotel room here.
Yeah, it means a lot. I'm excited.
This is
sunny Arizona.
Oh my gosh, yeah.
You can't tell from here, but
yeah. Well, you're a North Dakota native. When did you come up here again, or down here to Arizona?
2020.
Okay.
Was the official move with the family.
Gotcha.
Yeah.
So you moved down to Scottsdale area and decided to make the switch. I want to talk about first, before we get into like your story, like what is a holding company? Because I don't think these are talked about a whole lot. Like you hear the fund model, you hear the syndication model, you hear all that, right? Like what is a holding company?
Yeah, so holding company, and again, I kind of just fell into it. I mean, I was like 10 years old, just starting to raise money at 14. I didn't know what the heck I was doing. So this kind of just happened. It wasn't like that strategic, but looking back, it's been an awesome path. So the holding company is, instead of a fund, funds they expire. 5 years or 7 years, they expire, they're dissolved, and then people can reinvest in another fund. Or syndication project, right?
Yep.
Per project, that's the project you're in, nothing else. So the holding company model it never ends. It's a company, right? So Delaware partnership. Our investors buy units, basically shares, but it's an LLC, so you call them units.
Yep.
Shares in our holding company. And then our holding company owns everything. And that holding company of ours has been in existence for over 10 years.
Okay.
And some investors have been in since the start. Some have just recently bought in. People sell and buy shares between themselves without the company being involved. We have the first right of refusal. But in the holding companies, we have real estate. We have a chain of municipal equipment dealerships in the Midwest. We have, whatever we see that can bring value to our investors.
To the holding company. And so I thought it was unique. I know we've talked about this, but like you issuing new shares, or say all the companies are worth whatever. It's $100 a share. You have 1,000 shares. You can actually issue new shares, which can just reoccur for forever, I guess. As much as you want to raise money,
and we can buy back.
And you can buy them back. Okay, and the holding company would buy them back, or the other members in the holding company basically buy them back. And I thought it's just a unique way, because I've been listening to different people. Obviously, cash returns in real estate are lower right now. So you just can't find them with the debt. And you hear these guys making, Brandon Turner, just heard him. It's like, dude, I'm making a fund. He's like, I need to put some business in here to float the real estate. The real estate's the stabilization. The businesses are the really providing the cash value. So, and I thought that was interesting. So I want to make sure like everyone understood what a holding company was.
Yeah.
And this is really like what Warren Buffett does.
Correct. Yeah, he had partnerships back in the start, basically funds. And he had 7 of them from 26 to mid-early 30s. And then he merged them all into one partnership called Buffett Partnerships. And then he was so sick of trying to deal with people liquidating and buying in. So then he had a large ownership in Berkshire Hathaway, a C Corp. And he basically did a reverse merger somewhat. He's like, hey, I'm done with partnership. Whoever wants cash, you can have it. Whoever wants Berkshire stock, they can have it. I'm taking Berkshire stock, your choice. And that's what he did. And then the C Corp, Berkshire, was his new vehicle. And there was no more issue of this partner wants out or this partner wants out. It was all taken care of for him. And he could compound and grow from there.
Wow. And I think it's unique, or another factor. I mean, Warren doesn't believe in distributions. And there's no, I think that's the way your model works as well. And why is that? Like, why would you do that? Because everyone's like passive income and I want the cash on cash and, whatever,
He thinks that dividends force everybody to take a draw. And sometimes 10% of the company wants draws are 30%. So we think it's just unfair to force everybody to take a draw, which some people don't want because they have to get the money out and then reinvest it. Well, in a C Corp, that's double taxation.
Mm-hmm.
You tax the C Corp, you tax the dividend, you put it back in. So it's not fair to the ones that don't want it. So what he says is it's actually more economical to just sell some shares if you need money, because the shares that you don't sell with no dividends will go up more without having a tax filter. So whether you want dividends or not, selling shares is the most efficient when it comes to value creation. Most humans think, well, I have less shares, that's less value. No, because if there's no dividends, the shares that you have left and no tax filter will be worth more than what you've sold previous. So
gotcha. That makes a lot of things. So just you're minimizing your tax impact, letting your money compound. I always see like even these REITs, I think they're local in North Dakota, like most of the people don't take the distributions.
Correct.
They just keep them within it. Yeah. And so, okay, I have a better understanding of that model and why you wouldn't take a distribution. I think everyone invests in real estate to hope, it's like, I need the cash, and it's like, is the $1,000 a quarter really going to make?
Yep, and sell a share if you need her. So our shares went from $30,000 a share in 2012 to $300,000 a share. So that was a $200 million valuation in our mid this summer. And then we decided to do a split. I plan to never do one again.
Okay.
But we did a split down to $75 a share unit. So now every unit got 4,010. So now instead of 600 units, that was 2.5.
Okay.
The goal would be to get from 75 back to 300,000. That'd be pretty cool.
Yeah. Has like Warren done that same path?
He's never done a split. But when he had Berkshire Hathaway, it was about $7 a share. And so I did this, but in today's dollars, it would have been 75, so I just did the split to 75 so I could track it. Inflation adjustment.
You're going to beat him to the race?
So I'm hoping. So far, so good.
Gosh, you talking big numbers. And I mean, it's a lot. I think it's just, I think it's an interesting model that you follow like Warren's track. And it's a brilliant model. I think a lot of people are pivoting to that type of model. Yep. Just can't find the margins. How, you have like a interesting background because you started really young. You're 29. Mm-hmm. You've done a lot since then. You've had this holding company for 10 plus years. Where'd you start? Like, is this?
Yeah, I've done some other interviews. I started farm kid from Lansford, North Dakota.
Okay.
10 years old, started working, combine, grain cart, all the basics, $5 an hour. Saved up $4,000, invested in the market, turned it to $80,000 by the time I was 16. Bought some real estate, turned it to $1 million. I was a millionaire by the time I was like a senior in high school. On paper, didn't feel like it. And it's all invested. And then that's when I started raising money.
Okay.
And then Abernathey Holdings, my wife and I still own 32%, but we've raised $80 million.
Okay.
And now it's valued at about 200.
Okay.
And then we also have JV partners, one JV partner, and he comes in on every project for storage and also. So
yeah, wait, you skipped a big part there. It's like I gotta step back. Like, how did you turn $4,000 in stocks to 80? Like, is this like Bitcoin magic, or obviously it wasn't around then, but
yeah, it was.
How did you do that? Like, how does a young entrepreneur like figure that out?
Dumb luck.
Okay.
I was like 14, market crashed. It's like, what's this? Stock market, and I bought it March 23rd, which is a few days from the bottom.
Wow.
We had a great recession. I bought Ford at 99 cents. Bank of America.
Yeah, I remember that.
Again, just dumb luck.
You must have been really young, because I was like...
Yeah, I was 13, 14.
Yeah, I was sitting in my first days of college. I remember just watching it tank.
Yeah.
I didn't buy any.
Yeah, so I put $4,000, turned to 80, and I was 10th grade in high school, and then, that's when I wanted to get into real estate. And when I was 15, 16, I raised my first $300,000 from investors. Okay. And then that turned into, when I was first year of college, I had 10 million raised from people, then 20, and then now at 80 plus JVs, we've probably raised with bank debt, well over $500 million.
Wow. And so how do you, I'm thinking the young guys that are listening to this and it's inspiring them, I'm sure, but how did you gain the trust of investors at that young of an age? Because they're like, oh, you haven't seen, what I mean? The old guys always got to school you on something.
Well, I'm a nerd, so they liked my history knowledge because I've read about it, haven't lived it. That's what it is.
Right.
And I think the other thing they liked is I made it a no-loss situation for them. So, on the first apartment deal, I had $80,000, and I told my investors the first $80,000 loss can be mine. So that made them comfortable. Okay. And then I also took no fees. I worked for free for the first few deals. And then once I had that track record, then I was then I earned my right to start taking distributions and fees. And we've always been a a low fee company.
Okay.
I believe that my upside should be by the shares that I buy at the same price in terms as any investor.
Gotcha.
Syndication deals, for example.
Yep.
They'll take a management fee, an asset management fee, all these things.
Yep.
The holding company model, I get a salary, and all of that is within. There is no extra fees. And I think that's one of the reasons people are like, how have your shares 10x in 10 years? It's like, because there's nobody taking the fees. Like, it's all of our shareholders. It's pro rata share.
Right.
So that's been a really big.
I think the alignment with the investors, they're like, well, he's not going to fee us to death.
Yeah, there's no fees. Yeah.
You know, like a syndication or, something like there's some poor operators out there that literally fee the whole deal.
Yep.
Front end, and then expect to, and then if the deal doesn't provide any cash flow, it is what it is.
Yep.
So I do like the alignment that you have, like within every entity. It's just going back right to back end investors. I mean, you're paid a salary. Obviously, your share price is going up.
Yep.
So your net worth is going up.
Yeah, exactly. The 32% that I own, that's on paper worth $60 million now. I mean, I bought all that for $12 million over the years, and that was just cash from other deals we've talked about, apartments and all the stocks. And
Yep.
I threw my $12 million in like everybody else at that price, and now it's at 60. So
Wow. So we're gonna jump back really quick too, because I want to talk about the apartments. Because you got 80 grand from the stock market, and then you threw it all at real estate.
Yeah.
But then you mentioned that you were like, it didn't really feel like I had a net worth of $1 million.
yeah, I mean,
Those are real
it
feelings.
still doesn't feel like I have an extra 60. Like, I mean, we don't do dividends, as I said, and I don't sell stock. So yeah, I mean, my lifestyle has always been a lot different than my net worth balance sheet. It's just doesn't even seem real.
Yeah.
So yeah, that was a prime example of my balance sheet said I was a millionaire, but I didn't feel like it.
So you underwrote this apartment though, or whatever.
Yeah.
Took the 80 grand. You said you
Plus I had to raise money. So
Raise
I tried to get a bank loan with $80,000 for 1.25 property, and he said no. So I had to go raise my first 300.
Gotcha.
That was when I was 15, 16.
And you were operating that deal, or did you have a property manager and
Property manager, because I was in high school and
Jeez.
3 hours away. I was in 10th grade, and so
Wow.
I went down to Bismarck, 3 hours away, bought him, head back home, and I didn't see him again until we sold him to the city because the oil boom did hit, and the city offered us some pretty crazy money 10, 12 months later. Bought him for 1.25, sold him for $2 million. Not much after.
was that a blessing? Did you want to sell it at that point?
Well, looking back, it all crashed after. I was like within a few months, so I was like, oh, they're dumb luck, I guess. But after this, I tried to get smart. I'm not lucky because I was like, I gotta be smarter than this stuff.
Yeah.
This is seems like dumb luck.
Yeah.
I don't want that forever.
And well, I'm sure you earned some trust of investors
Yeah, I
and
did.
started building that track record. So that's super interesting to me. And then, obviously now everything you own is within a holding company, basically.
Mm-hmm.
You've never sold shares of Abernathey Holdings. You've only issued new shares.
Yeah, so we've done some buybacks. We bought 10% of our company back in 2020 from shareholders that have been in a long time. And
Oh,
they just
okay.
wanted out, or they sold some, and then we did. I'm a believer that access to capital and good debt and good capital at the same time of having access to good deals is rarely at the same time. So we raised out of the 80 million, we raised 50 million of it in 22 and 21. When COVID checks came out, we're going to raise money at a good valuation. It's now. So we did, and to this day, right now with the economy crashing, we've got 50% of our balance sheet's cash.
Wow.
So we are deploying. Well, we're poised to deploy it here as things kind of start showing themselves some good deals. So
Yeah, and you're in a great position. I think I was on a podcast yesterday and we were talking about the amount of dry powder still inside. I think that's what's different about and we could talk about where the market's at, but in 08 there was hardly any money. You couldn't even get bank debt.
yeah, and right now it's tough to get bank debt. It's
Yeah,
getting harder. I mean,
right.
they're saying it's harder now than 08 to get bank debt. They're saying, which
Wow.
I don't know if that's true or not, but
I suppose they're just smarter now.
things take time, right? You first inflation, then interest rates, then the economy.
Okay.
I think 24, there's going to be a little more pain than people have seen. And
Okay.
it's delayed pain because of the slushy cash in the system. I mean, American savings accounts are dropped dramatically. They've
Okay.
plummeted.
Right.
Subprime auto delinquencies are the highest they've been since 08. You're
Yeah.
starting to see things crack, and I don't see it getting better for a while.
Yeah.
So, let's talk the markets a little bit and where they're at. How would we, let's talk about how we got here and, whether COVID was planned or not planned. Maybe a whole nother podcast, but what happened in 2020? basically when you moved to Arizona, and like, how did we get to this position?
And I think we should go a little further back too. And I don't want to get too in depth in the past. I'm a history buff. I think one of my talents is analyzing things. And I think one of my weaknesses is overanalyzing things. So it's a fine line.
Okay.
Right? Because keep it simple, stupid, the model my dad taught me.
I love it.
The KISS model.
I talk about that all the time.
Yeah. So I try to keep it simple. But you go back to the Habsburgs, they really didn't have a global currency at that time because it was back in the 1400s. And then after that, it was the Dutch. The Dutch created the first basically stock market, and they created the best ships that traveled the world to get the gold to become the wealthiest. And they were very innovative and everything, right? So they had the global currency, the guilder, whatever it was called, right? And then you go through 6 cycles, and the powerhouse does, right? And they went through the cycles, and the stage 3 is the healthiest. That's the most innovative. There's peace in the world because usually a war has been done, and everybody knows who's the powerhouse is. Well, then the next one was Britain. British came, the sterling, the pound. That was the new powerhouse, right?
Right.
The world power, and same thing. They took it from Dutch because they had cheaper labor. Because once you are the powerhouse in stage 3, all the incomes, everybody comes up. So it's hard to build and compete. So the next country will just take the same technology with cheaper labor, and they can outcompete you. Okay, so then we came. We had our World War I, World War II. 1945, we were the new world currency, the dollar. Well, what happens, and every single time you're the power, is if you are the world power, you basically have the license to print money. Okay, and there's your fiat, non-fiat, the gold standard for us, or silver back in the day. So what happens is you separate a hard asset from the dollar or a currency. They've all done it. Sterling and everybody. And what happens is you have the license to print. And when you're in stage 3 and everything's great, going into stage 4 of the six stages, you start printing money, and GDP per capita is going up, and everybody's happy. There's peace and prosperity because the war was just done. Everybody knows who the world order is. Well, what happens eventually is your debt gets too high, and where we are now, I would believe, on the beginning of, we are in stage 5, going into stage 6. There's short-term debt cycles, and there's long-term debt cycles. We are at the beginning of the end of a long-term debt cycle.
Okay.
What happens is the disconnect between hard assets and financial assets. So meaning back in 1970, 90% of the whole stock market was tangible. 10% was goodwill, intangible. Today it's 10% tangible, 90% intangible. And so what happens is our debt to GDP is about 127%. In 1951, it was 117%. In 1985, it was about 51%. Okay. And if you look, do you want me to continue on this? Because I don't want to bore anybody.
This is interesting. You're taking a concrete guy to school here.
Okay.
I got to listen.
Okay. Any questions?
This is interesting.
Stop me.
Well, I'm following so far.
Okay. Because I nerd out. So if you look at, when there is wars, you have a lot of printing of money. Okay. And after the war, after printing, you have inflation. Inflation goes up. Fed has to raise interest rates short term to spread that inflation out. It doesn't get rid of inflation. It prolongs it, actually.
Okay.
So in World War I, we had about a 36% deficit to GDP that year, filled with money, printing. Okay. Caused inflation. 1940, 45-ish, around World War II, we had about a 22, 24% deficit to GDP.
Got it.
When COVID hit, it was about 15, 16% deficit to GDP. The difference is, in the wars, the money was sent out for the war. The COVID was helicopter money over the society, which then inflated all of these assets. Okay.
Got it.
So the question we have to ask ourselves, fast forwarding to now, is inflation around to stay? Yes or no, and why? Will interest rates, nominal and real, nobody's ever had to think about real interest rates because inflation's never been around. So there is a difference, right? Because back in the 80s, if you made 20% return, inflation was 18, you really made 2. Okay?
Gotcha. And
in the last 10 years, if you made 4%, inflation was 2, you made the same. So 4% return was the same as 18%, 20% in 1980s. People don't think about that, nominal and real. Inflation is an invisible tax.
Right.
So I think going forward, what I see happening.
Okay.
And there's no guarantees.
And this is a proof of following history.
Yes, which I can go in a lot more depth. But What is inflationary that's happening and I think will happen? What's inflationary? Wars are inflationary, printing of money to fund the war. What else is inflationary? Just deficits in general. Right now, we're at about a 5 to 10% deficit to GDP.
Okay.
The interest expense went from number 6 as a cost for a country to number 2, right below military. Okay. So we have a $33 trillion debt load.
Yep.
What else is inflationary? Deglobalization. That is happening, right? Tensions are getting tight. We are past the prosperity stages. We are into the conflict stages. We have inter-country conflicts and separation, gaps of just people disagreeing, which is very common in the stage.
Left and right.
Yep. And there is no middle anymore. It's very tight.
Yeah, that is interesting.
And immigration policy's broken. That's very inflationary. And the green energy. So the whole world, right or wrong, doesn't matter. What they're doing is they're trying to go to clean energy. The world has $100 trillion GDP combined. And they are projecting a $5 to $10 trillion cost annually to go to clean energy. There's another 5 to 10% deficit in the US and everywhere. Okay, so now you're at easily 10%. How do you fill deficits? And then interest rates. How do you fill deficits? It's all inflation. So the Federal Reserve is going to have to keep nominal and real interest rates higher than average to keep inflation at that 2 to 3%. The only way to do it is defaulting.
Yep.
Or printing money. There's never been a developed country that's ever defaulted.
Okay.
Because they don't have to. They can just print money.
Print money, yep.
So you're going to see money being printed. You're going to see inflation higher than average nominal and real interest rates.
Okay.
And they're going to have to inflate away the debt. And what you're going to see is the financial assets and real assets coming together in the future here.
Like a decade, how long does that take?
These cycles usually take decades.
Right.
And I'm not saying we won't be the world power. China's on the uprise, we're on the down. So if we can change some things, we'll be fine. But they're probably going to want to do a war to see if they can win and be the world power.
Oh.
And everybody always says, well, after World War II, our stocks in America took off. Yes, they did. But 7 out of 10 countries, the 7 that didn't win, their markets shut down for 10 years and opened up at 0.
Wow.
Even the 2 other, so there's 3 winning countries.
Yep.
The U.S. stocks went up. Even the 2 other ones that were still in the winning camp, their market didn't even do what ours did.
Really?
And I'm a believer in America, and we are great. We are, but there's never been a group in history to ever keep the reserve currency forever. And fiat currency, non-fiat currency, it doesn't work. It's never worked more than 75 years. And with the gold standard was back in the 1900s. So we're kind of coming up on it, and our numbers are showing our deficits in a bad spot.
So does, future, I mean, you have fiat, you have Bitcoin, you have, which is this disconnect of now Bitcoin starting to surge a little more. Is that, you talked about the gold standard, is that kind of replacing, do you think? Or where does like some of this cryptocurrency come into play?
Yeah, I think the blockchain technology and all of that is amazing. I think utilizing it in a pre-existing business is where it's at. What I'm not a gold guy. I'm not a currency or gold. I look at it like this. If I buy something, farmland, a real estate property, an operating business, if the market shuts down for the rest of my life and there's never again a buyer, that produces me income. Okay. If you take, I think the gold market is like $10 trillion, whatever. If you buy all the gold in the world, it would be $10 trillion. Okay. So let's say I gave you $10 trillion and said, hey, you have $10 trillion, go spend it. You could buy all the gold in the world and kiss it and hug it in your backyard and look at it. It's beautiful. Well, it's not going to do anything. Or you could buy, I think, like 4 Exxon Mobils, all the farmland in the world, and still have like $1 trillion or $2 trillion walk around money. Wow. Which one would you pick?
Yeah, right.
I'd pick the income producing assets. So currency was invented to eliminate the time it takes to barter. That's what currency is. Whether people are paying me seashells, Bitcoin, or dollars for my assets in the future, it is a quick, I do that, I buy something else that's income producing, that has the economics that I enjoy and look for.
Right.
I guess that's my take.
Yeah, that's why I think money is garbage in most cases,
cash is
as long as you own some kind of asset. So if I'm listening to this, I've listened through your history course on. I mean, did you learn all this from a book, or is this like something you research every day?
Lots of books.
Okay.
Ray Dalio is great. Ray Dalio. I mean, there's a bunch of people, but I read about 2 books a week usually.
Wow.
So,
Geez, you must have like Jim Quick's like reading. You know what Jim Quick is?
I do not.
He's like he teaches speed reading.
Oh, really? Yeah,
Yeah.
I do. I have an audio one and I have one paper, so I do 2 at a time.
Jeez. Yeah,
Not like at the same time, but
Yeah,
like
right.
same period of time.
You're a beast.
Not like at the same time. I can't read and listen to different books at the same time, but
Yeah. So, okay, we know the history. What are you bullish on in the next decade then? You know inflation is going to be grasping
I would say it's higher than average. Yeah. So what's going to happen first is, all stocks and real estate is somebody paying $1 today and they're projecting the future earnings, discounting it back using the interest rate as their discounted cash flow, right? So the lower the interest rate,
Yep.
the more they can pay for an asset with
Sure.
the same earnings. The same earnings, higher the interest rate, the less you can pay. That's all it is.
Yep.
So what you're going to have in the 70s, it was pretty interesting. So I can see cap rates being higher than average. Here, I think the spread between the 10-year and cap rates of real estate will be tighter. But I think the 10-year is going to be at the 4.5% to 6% long term here instead of the 1.6 to 3%. So, the average cap rate for real estate since 1982 is like 7.62%.
Okay.
Okay. 33% of the time it's below it. And 67% of the time it's at or above it. Okay. Every time it goes below it, there's a bubble after.
Gotcha.
Or late 80s, 05 to 07 just happened.
Yep.
Right. Now it's starting to come up. So my model is when I can get and in development, you need a spread.
Yeah.
Your yield to cost to projected cap rate. So we're going to continue to underwrite properties in self-storage at a 9% yield to cost. And if we can find them, great, which I think we're going to go into a period of those being there, if not better, right? So that I think real estate's good once things correct. We are about there. It's happening. Reality always, it's a delayed reaction.
Okay.
People are silly. And so I think that's good. But what happened in the 70s is interesting. So when inflation was there for a while and going up,
Yeah.
okay, in the late 70s, people bid up real estate. And there was an inversion. There was the cap rates were below the 10-year bond because because it's inflationary. It's a good inflation hedge.
Yeah.
And that's what you eventually led to the 91 bubble bust. So if inflation is higher, now if it's a steady inflation, I think cap rates will just adjust and they'll be pretty steady, but nothing's ever steady. So if inflation does take off and they get behind on it, you're going to have people go and bid real estate up to silly numbers again as an inflation hedge. Again, they'll make money if they can sell it to someone for more. That's gambling, not investing. So I think we'll be in the business here. Yeah, real estate. Another thing that's good in inflationary environments is asset light businesses. So like Normand Equipment, our dealerships.
Okay.
We do about a 20 to 25% return on tangible capital. That's total assets.
Okay.
No goodwill, just tangible.
Okay.
Total assets. And so every dollar he keeps and or we give him, he sends home back to us, the parent company, 25 to 20 cents.
Okay.
That is a good business.
Yes.
Because in theory, two businesses. One has 20 million in assets, making 2 million net. One has 10 million assets, making the same 2 million net. I would pay way more for company B than company A. Because if inflation doubles, you'd have to rip a check for 20 million to double the 2 million.
Yes.
In company A. Company B, you only got to rip a $10 million check to double the earnings. So again, asset light is better in inflationary times.
Gotcha. Yeah, I like that. How many of those dealerships do you own, or are you looking to acquire more businesses like that?
Yeah. So I think so. We've told Luke to start our CEO there. We bought the company back in 2015. Started in 1947. It was a small business when we bought it. They were doing 3-4 million a year in revenue. He's doing 12 now at the one location. We just built a new facility. He's got the processes and the models. So now I can see him starting to probably print another 5 to 6 more. So, that's only got 5 million deployed there in assets.
Yep.
So I think we could probably get that business to 50, 60 million in assets. And if he can do the same 20 to 30% return on that, that should be good. Storage, cash terms, if we are going to sell and recycle because of the return after stabilization, we could probably shove 100 to 200 million of our holdings cash into that.
Gotcha.
So I'd say in the next few years, I'm going to have to find a third division because we'll have more cash than that. So
Gotcha.
So for now, we're just trying to capitalize on what we have.
And you is there businesses that you're looking to go out and find? I mean, is there specific areas you're looking at?
Time changes things. I know what I want
Okay.
when it comes to the numbers, but I don't have like a company or industry in mind.
Yeah.
But when we get closer, I know exactly what I'm looking for when it comes to the return on tangible capital and balance sheets and all that. So
yeah, I think Brian Lubin, I think I was listening to one of the podcasts, and you were talking about $250,000 net per employee.
Yeah. We like employees are tough, so that's why storage is great. Farming,
yes.
We look at net income per head.
Okay.
Because people's salaries in inflationary times will only be pressured higher, and you're going to have employment issues.
I like how you say net, like
not revenue.
That should blow most people's minds if you're listening to this. So
a construction company has it. We have a garage door dealership. These are all verticals within our. And I have in my mind, I have a real estate division and an equipment dealership division. But inside of those divisions, they also have vertical companies as well
within them.
So we incentivize our managers on return on capital, tangible capital.
Yes.
And so they have an aligned interest with our owners.
So yeah, you're not only just building, you're not hiring someone just to build the real estate. You're building the real estate, giving the garage, you're going to mark up all along the lines. So I think that's what's super unique about your holding company and just a lot different. It just aligns so well. The pitch is probably not even as hard with the investors.
Yeah, no. And
we're going to build this. This is our plan. Mm-hmm. Here's all the companies you get to enjoy. The income of everyone.
Yeah, there's no guarantees. We're long-term thinkers. I mean, right now we're 50% liquid cash. Like that's 2 years ago, a year ago, everybody thought I was crazy.
Yeah.
And now they're like, oh, this makes sense. Like this is, like I said, the time to raise money and get money is always different than the times you place it.
Gotcha.
There's a Warren Buffett, Berkshire Hathaway, they issued like $6 billion in bonds in Japan at like 0.6% interest 4 years ago. And they already had $100 billion in cash on hand. So everybody's like, why the heck would you do that? He's like, well, it's 0.6% for 20 years. Like, I'll find a place for it eventually.
Yeah, right. Absolutely. Well, and I'm pretty sure that guy's buying right now, right?
Yeah.
Because he's sitting on a ton of cash.
He's getting there. Again, it's delay, right? And inflation, interest, economy. We are not yet. The economy is like the bad news the other day. Unemployment went up and the market rallied. There is a
the market. Bad news is
good.
Yeah, bad news is good now. Yeah, we want bad news.
So it's just a weird time. I think investing is more about temperament than IQ, right? Like, you don't need to play 3D chess or you don't need to be that smart. You just need to have temperament. Whether 1,000 people agree with you or disagree, it doesn't make you right or wrong.
Right.
Yeah, and so you just need to be able to just, you can get 1,000 pitches. There's no strikes in business,
right?
And you just wait for the right one.
Yeah, I always tell everyone, it's like you're either a trader, like if you're not thinking in terms of at least 5 years.
Oh yeah,
you're just trading business.
Yeah,
you're not really like. You're not an investor. You're not an investor mindset because like Robinhood, for instance, that app came out, people buy and sell like weekly and think
cocaine for kids
and they're investing. It's like, you're not investing. You're a day trader losing your ass.
Yeah.
I guarantee it.
If the market can't shut down for 10 years and you're not okay with it, then you're probably not investing because who cares? I'm not in the stock market. I'm not. I mean, we do all private stuff, but it doesn't matter whether you're buying stocks or private. It's all representing a real thing.
Yeah, and I'm a true believer that you invest for the long term. You don't. I like that you don't even do dividends, and I think obviously the double taxation part I didn't know about, but I think
C corps, most LLCs are a little different.
Oh,
but still the same mindset of just
Gotcha. And I like how you can say, hey, I was in high school. I bought some stocks with $4,000. I scrounged up from farming and turned it into 80. And then you threw it right away into some real estate.
Yep.
And then all of a sudden you buy the real estate and you're like, geez, I still don't have any money. You have the net worth. You don't feel like it.
Yeah.
And I think it's always that way as a good investor. You're owning assets. You're building wealth.
Yeah.
And then today, now you have all your assets within this holding company and you just get a paycheck. You're an employee of the holding company.
Yeah, and my wife and I have 3 beautiful boys, amazing wife. We live a great life. But I don't think the problem with the world is greed. I think it's envy, right? Like envy is so unhealthy. Like if you're envious of this person for this house or this car, someone's always gonna have more money.
Yeah.
Right? And if you need, and trust me, we have a good life, but I don't look at nice things as happiness. Like if that brings you happiness, then good luck with that.
Right.
It's just to me, it's a waste wasteful time.
Yeah, and you delayed the gratification.
Yeah.
To get to where you're at, and you're still not to where you want to at. You
Yeah.
want to be at $1 billion in 5-10 years. It's like you probably will be. You're just delaying the gratification even longer.
Yeah, and at the end of the day, I mean, we'll probably give most of it away. Like it's to me, it's just fun to build something. And it sounds really cliche, but I like making money for good people. Like, if it's a good person that's an investor in our shares, which all are, because I vetted them thoroughly, and I still vet if somebody wants to buy shares. Like yesterday, we had some guys like, hey, can I buy some shares from this person? And we have to approve it. And I vet them. So if I can make money for good people and they do good things with it, that's a win. That makes me feel good.
Yeah.
Simple as that.
Is that that's what motivates you then to keep going
100%
every day?
𝗨희 and I give a lot, and we advise people that we love to give, and I think I'm here for a purpose, and it's to do good in the world. So
yeah. Shout out to 𝗨희 who
Thompson. Thompson, North Dakota. Tommy's right.
There's not a whole lot of us out there, but we flock apparently around. So
that's right.
No,
she's
good.
the best.
Yeah, and you guys are in Scottsdale. We're still up in North Dakota, but one day we'll probably venture around. We're not really sure what our long-term plans are, but so what, another question, what is one of your best investments and what's one of your worst?
Start with worst.
Okay, let's do it.
We had Holdings was probably worth $20 million. And there was this helicopter company. This was when I was good at a lot of things, but not great at anything. And there was a helicopter company publicly traded, and it tanked after oil crashed, right? And there was like $2 billion in assets, and it was selling at like a $200 million market cap, like $10 a share.
Wow.
So I threw $1 million in. We turned it to the starting sounds good. It gets worse. It went to $20 and we sold in like 10 months. Oh, cool. Yeah. Nice. Perfect. Doubled our money. That was best investment almost. Then it started to drop, and the model, hey, it's the same company, went down to $13 or $12. Okay. So I put $1 million back in, went to 10, put another $1 million in, went to 8, put another $1 million in. Wrong management came in when it went to 5. There was supposed to be an exit. So I would have made it 6.
Oh,
it was announced. Life was good. I'm like, dang, perfect. There was an announcement, a big merger. And last minute, some management switch. They called it off. They basically parachuted the CEOs and everybody out with the big paychecks. And then they turned they had 50 to they had like 100 million in their checking account. They purposely missed a $20 million interest payment, and they went into bankruptcy and gave it to the debtors. And then the debtors sold it for like $3 billion. So I led a huge class action lawsuit, and we won, but it took 3 years, and we got 10 cents on the dollar. So we lost. So that we lost 15% of our portfolio roughly.
Right.
And that was pretty devastating time. And that's when I learned to, do more focus and have a little more control.
Yeah.
So that was my worst investment. Best investment, I mean, gosh, those apartments were pretty good. The stocks were pretty good. I'd say my most unique investment.
Well, you were just so young. Like how, what I mean? Like that's the cool part. You were in high school.
I think a fun story and a unique investment was Warren Buffett always had these insurance companies, and he would invest the float.
Yeah.
So I'm like, okay, I want to buy an insurance company. So I went on the NASDAQ and I searched all the insurance companies, and I found one that was selling at a $25 million valuation, market cap. And they had a $50 million book value. Wasn't big enough, so the big guys didn't have any interest, and they were selling at a discount.
Yeah, okay.
There was only 200 shares being sold a day, low volume. So I started buying shares, the holding company, and we ended up becoming the largest shareholder.
What percentage is that?
Well, the family had 20%, so we got to that.
Okay.
But we had to we had to tell the state, because insurance commission is state run and it's very strict, take over and stuff I was learning along the way. You're supposed to do it at 5.
You're just buying shares?
Well, you're supposed to do it at 5%. I got the 10%. And I got a letter. I'm like, oh, my bad. I played dumb. Yeah, I'm kidding. How am I supposed to know? Anyway, so I fly down to Elba, Alabama. It's where this company is. They got $75 million in annual revenue. They got 90 employees.
Oh, geez.
$150 million book. And so I fly down. I'm like, hey, this is me. They're like, 'cause they didn't know who this was. They were all nervous. Like if it was a takeover person, here I show up.
Oh yeah.
I was like 22, 23. Hey, it's me.
Holy shit.
So I'm like, hey, I'd really like a board seat. And so they're like, hey, I mean, we have a bylaw that says you got to be 30, but we can change that. But the state commission, insurance commission has a rule too, like NASDAQ, like you got to be 30. Like it's like a rule. So I'm like, well, how do I change that?
30?
Yeah, apparently.
Really?
Yeah. So I'm like 23. I'm like, well, how do you change that? So they're like, well, you got to go to Montgomery and do court hearings and get an exemption. So I spent a year to 2 years. I had audits. I went and did a few court hearings, and I got the exemption. I was 24 and joined the board of a public company.
Oh my gosh.
And the goal was to actually do a reverse merger, make that my Berkshire and be public. But then I found out that the board of 12 people that were all descendants from the founding fathers, there wasn't much getting done. It was kind of slow moving. So I realized that, this is too clunky. There's too much family dynamics, and we needed to get bigger or not be public because it was just too small. So then I got a couple people together. We convinced everybody to sell, got an investment banker, and we sold it to a billionaire out of California for like 53 million in early 22. And thank goodness, because remember, insurance companies have bonds. If interest rates have skyrocketed, that book value must be next to zero. Because like the Federal Reserve lost $1 trillion this last year and a half on their bonds. Like the Federal Reserve should be bankrupt.
Oh yeah.
But they changed the rules.
Okay.
Yeah. So they're $1 trillion down. That's another deflationary thing because they're going to capitalize that and spread it out for 30, 40 years.
Oh yeah, for sure. Well, we'll pay for it.
Yeah.
Or pay for it through inflation.
Our dollar will just, if you have dollar under your couch, maybe not yet, but you got to put it to work because inflation, your dollar will be worthless.
Right. Well, since you bring that up, and I like that as your best investment. So you had a good exit. I mean,
yeah, it was fun.
And you got out of it.
It wasn't the best. It was a good return.
Yeah.
I've had some way better returns just because of silly deals, but that was a funny. That was my most. It was a lot of work, a lot of strategic.
Holy.
That's
a lot of learning too.
Oh, I learned a lot. Yeah.
You got to be 30? Like that's a rule?
Yeah, let's change that.
Yeah. Here you are 24. It's like, I'm going to walk into the board and then you're into a family and oh man.
Yeah, it was really cool though. Alabama, I spent a lot of time in Alabama. They have a lot of Waffle Houses. I always ate there.
The Waffle Houses.
That was my go-to.
Yeah. Here comes Andrew.
Yeah, literally. Yeah.
Yeah. Oh, that's awesome. So you mentioned though, like, inflation's going to be around for a while. It's going to be killing cash. People are sitting on cash too, though. They're sitting on it in high yield savings accounts, buying bonds. I don't know really what, they're sitting on it.
It's hard to compete with a 5% interest. And that's where,
right.
The valuations of stocks right now are way too high because the stock market's expecting interest rates to come down. That's how it's priced.
Gotcha.
So if they're wrong, it will happen.
And all this cash is sitting there because all these asset values are still elevated. Sellers are, I don't know, the cap rates are obviously still skewed.
They're coming up, but they aren't where they should be.
Yeah. That's going to take all of 24, you think? I mean, should people be sitting on cash and be waiting till 24 comes? Or where would you recommend right now with someone with $1 million in cash?
Yeah. It is hard. Nobody knows, right? I'm not a believer in time in the market, but I'd say this would be the best time to hold cash short term here.
Okay.
This could be more of a balance sheet recession. So it's more of just like you said, there is liquidity out there in cash. It's 40% of new printed money slushing around the system.
Yeah.
And all of the states still have $950 billion left to spend, and they've got to spend it by the end of 25. Well, that's all done in infrastructure, which is jobs.
Yeah.
So there's a lot of money out there, and that's why we're not in a recession yet, I think, is because of that. So yeah, I'd say, have your cash. I'd say over the next 12 to 20 months, you should see some opportunity. And remember, if the market does 0% growth and inflation is 10%, that's a 10% drop. So don't look at the market in a year and say, what the heck? Andrew said it's going to drop. It didn't go, or it went up 5%. It's like, well, real and nominal returns, people. We got to start thinking about that.
Yeah.
We haven't had to do that before.
Yeah.
And then the tensions with China would be better if a war was delayed because they're getting stronger. The U.S. would be better if it happened now, which sounds horrible because I don't want a war. I'm just saying if we had to have a war, that would be, and that also you're going to have a flight. The only reason our 10-year would go below 4.5, which is flirting with today, is because people will flight to safety when wars happen, which will be our bonds. But then again, people are wondering like, are they really going to pay this? Because they have a lot of debt. And that's where the U.S. has to pay more interest to entice people to buy the bonds. Because are they going to pay it or not? And if they do pay it, maybe they're just going to inflate it away where holding debt is not going to be a good place to be in inflationary. You do not want to be a holder of debt. Because if money inflates, it inflates your debt away. And so.
Gotcha. So like
hope that answered, I guess.
Debt on assets, it would be.
You don't want to be the owner of debt.
Owner of debt.
Yeah, you can have debt.
Yep.
If you have a house mortgage at 3% for 30 years, your house is going to inflate to 5x, not because of the intrinsic value just because of what it's bought and sold in, the dollar.
Gotcha.
Well, if you're borrowing at 3, you're going to make arbitrage just on inflation to interest.
Gotcha.
Owning it. The guy
Owning
that has that debt, that gave you the debt,
he doesn't want it.
That's a bad deal.
The banks.
He's going back. And the banks have sold it to bonds. So some bondholder, Wall Street dude, I mean, everything's resold thousands of times.
Oh, yeah.
Somebody out there is pissed off. And they're like, damn it.
Someone bought a lot of a lot of cheap bonds, and
the bond market's already crashed 80%.
yeah, that's true.
Values, right?
Yeah.
So there's already been a crash in
Right.
just bonds, and nobody talks about it.
Yeah, I think, and just everything is unaffordable. I think that's dry powder on the sidelines. I think every valuation of every company is still high. All the assets are still high.
It's fake.
But I always think about like in 2020, like when the freaking skyrocket of stock market, everyone's like, woo.
That always happens after inflation too.
Right.
That happens.
Yeah, the baby boomers are like, all retiring, and that's our best workforce out there.
Yep.
And so now we're losing all them, and then all of a sudden the stock market comes back down, and now it's been like level from 2019 to like now.
And you had inflation, it's actually down 30%.
Correct. So I like how you said that. It's like
Down a
actually
lot.
you're down. If
A
you're
lot.
doing the same the last 4 years, you're down quite a bit.
Yeah, it's
unfortunately.
inflation.
Yeah.
And everything's manipulated. Like look at Japan. So the only reason our 10-year took so long to get to 4.5 is because Japan had a delayed quantitative tightening. They were in quantitative easing because they have more debt than anybody, and they basically had a free pass to inflate their debt away. So they let inflation soar.
Gotcha.
So what happened is all the Japanese government and citizens, they were buying our bond, putting pressure on it because their bond was next to nothing.
Yep.
Well, then when they started tightening, then they took their money back, and that's when our interest
sell
rate
the
went up.
bonds or whatever they do with it.
Because again, if there's a lot of people buying our bonds, interest
Bonds
rates
stays-
go the opposite. And
Gotcha.
that's in the flip. So
Got it. Yeah, we're in a little bit of a nightmare, but I think you got to get your money working for you somehow. And
Yeah.
if you're going to be doing the same for the next 2 years, even after that, like you said, 12 to 20 months.
you should be some opportunities.
I mean,
here.
it could be flat though. The stock market
Yeah.
could just,
but that's a win because if you're making 5% of your checking account, do not like I do. Cash is trash. I'm just saying right now you're making 5%,
Right.
And nothing's trading where it should.
Yep.
So you're ahead.
Yep.
But once things correct, then you should take out and put it to work in some real estate or
Do you see a big dive coming? Like, do you actually see like a huge, not like an 08 because that was pretty dramatic.
Yeah, 08 was
I don't
similar.
feel that, but
08 was similar to the Great Depression.
Yeah.
And after the Great Depression, for most of the 30s, interest rates were also next to nothing. And then you had the 40s, 50s. So it's happened before. We're just going into it. I don't know. A correction needs to happen.
Yeah.
It could be a rolling correction.
Okay.
Because we're kind of in that right now. It's just even being flat from 1970 to 1980, the stock market went up 0 inflation adjusted, the last decade.
Gotcha.
10 years, inflation adjusted went up 0 roughly.
Wow.
So I think you're just going to have something more like that. And I think the general market is where it's at, but there's a lot of buys already. I mean, Magnificent Seven, they call them.
Yep.
If it wasn't for those, the market's down a lot. Like it's just a few companies holding it up.
Okay.
So there's a lot, there's plenty of companies I know that are down 50, 60% already that are good companies.
Yeah.
So again, I'm not in the market.
It's correcting.
But in real estate, I'm hearing a lot of people say now, like we're trying to buy land. We have one site. It was $9.5 million a year ago for dirt in California to build a $30 million project. And we didn't do it. She called me up last week and was like, hey, can we meet up? So she flies in and we sit down for breakfast. And she said, how about, 5.5? And we're just like, so we're going to go back. We're going to send her an offer this Friday for $4 million. But the comments you're hearing are, I want to make a little bit for all my time. Okay. That's going to change to, I just don't want to lose much. So we're seeing it happen. We've made 5 offers for $100 million the last few weeks on land. We haven't got one, but I see that it's getting closer.
You get a call back soon.
It's getting
They're
closer.
calling back. I put some offers on deals, and they're like, let's try to get this done. Let's figure out how to get to. Yeah. It's like come down in price. I mean, or give me like super favorable terms.
Yeah, and every one of them says, interest rate will drop. Of course, they're just trying to sell the project. It's like I'm not taking that risk.
I'm not doing
Even
it.
if I'm wrong and interest rates do drop back down, I'm not taking that risk. I
Yeah.
can make 5% of my checking account right now.
Doesn't matter.
Yeah, it's
Doesn't
not my
matter.
problem.
Yeah, yeah.
If you're right, I'll pay for it then. I'm not gonna pay for it now.
no, yeah, absolutely. What's one of your biggest fears?
For the future,
Let's just say in general. Yeah.
general, worldwide, it'd be the nuclear war. I
Okay.
think that's the biggest threat to humanity.
Yep.
you know, in business, my biggest fear as a country also would be where we are with debt, and the American citizens reliant on debt personally.
Oh yeah,
credit cards and all these things. I mean, we are an economy of credit. Another worry I have is they've kept extending the amortization length of mortgages to make things affordable, and that's not the answer. It actually it hurts, because back in the 30s, I think they were like 5-year AMs, and then in the 80s, they were like, we should do 15 and 20-year AMs. Now it's 30. My worry is their solution to this unaffordability is let's make a 50-year amortization. That'll help. No, it doesn't. Help for a little bit, and then everybody's just going to jack prices up till it doesn't.
Yeah, right.
So yes, it's great for guys with money.
Yeah,
but it's so sad for the American citizens.
Right. Think of the people graduating college with $100,000 in student debt, and then try to go buy a $400,000 house with an 8% mortgage.
Yeah, if they do 50 years, it sounds good now, but it's like 50 years.
50, yeah.
So
you're never gonna own it.
Yeah, the distance between intrinsic and real assets, like I said, is getting out of hand, and I think we could have a generation of that gap tightening. And so you just got to be in the right things. I'm just really worried about inflation turning into hyperinflation.
Yeah.
Worried about losing the global currency and what that could do to the markets and valuations. But again, I am a positive person. I'm not a doom and gloom guy, I promise. So I'm going to keep on keeping on. But we are just in a bad spot. We've been spending money like drunken sailors.
Oh, geez, I like that. Yeah, it is, and I like that you're very much an entrepreneur. You're very much optimistic. But it's like this is just the history of what it's telling us right now.
Cash is like oxygen. It's when you have it, you don't think about it. When you don't, it's all you can think about. So I don't like cash, but I do keep it on hand. I have low leverage. I'm in the game for 1,000 years, hopefully. What I'm building, I want to go forever.
Yep.
And that's where I'm okay with 15, 20% annualized returns, which is high, but you have some people shooting for way higher using leverage. Good luck with that.
Yeah. Where do you see yourself in 10 years?
Company wise? Yeah. Well, hopefully,
personally,
my beautiful kids hopefully still love me, and I'm sure they will, though. I spend a lot of time with them. Beautiful wife and I, everything will be hopefully still good there. I mean, obviously that takes work, just like anything, and so that's the main goal.
Relationship. Okay.
Yeah, relationship,
I like that. Those
family.
are good ones.
I have the 5 F's: fitness, family, friends, finance, and faith, right?
Faith.
So trying to stay a little more fit. You should have seen me a year ago. I've lost some weight. I'm proud of that. So keep that off. That's a goal.
You're working out,
staying healthy, try to be around for a while.
Yeah, hey, as you get closer to 30 and right after, I'll just tell you it.
Yeah, I know it's hard.
You got to work really hard to
So I'm starting that.
Yeah, I eat a cheeseburger, my ass jiggles for like a week now, and I gotta keep working it off.
Fair enough.
Yeah.
But company-wise, I'd like to hit that at least $1 billion valuation, in the next 10 years. We're at 200 now, and billion plus, and I'd like to get it to $1 trillion eventually.
Wow.
But again, with inflation, that'll make that goal easier, because $1 trillion won't be what it is today.
Yeah.
But that's long term. It might take me 50 years to do that. So
yeah, well, you got a lot of time in front of you.
Yeah.
And
stay healthy and
keep doing smart things, and taking care of yourself. And
yep.
I love that. One last question: what does "follow the herd" mean to you?
I think it goes back to whether 1,000 people agree or disagree doesn't make you right or wrong. I think it goes back to temperament is more important than IQ, like we already talked about.
Yeah.
I think when you see a lot of people doing something, euphoria, it's usually a time to sit back and not do things. Doing things opposite. If you want to be different than the crowd, you've got to do things differently than the crowd.
Yeah.
And I've been pretty good. I think I have a little Asperger's or something. I don't notice much things around me. I'm kind of just, it sounds good. I really don't care what everybody else does.
Right.
So I think that helps me a lot. I guess, that's kind of broad, but I'd say those are the things that come to mind.
I like that, man. Where does someone reach out to you if they want to learn more about Abernathey Holdings or just Andrew in general?
Yeah, Facebook. I'm on Twitter and the LinkedIns and all that. Andrew Abernathey, EY at the end. Don't forget the EY. It's silent.
We'll link it below. We'll get you linked up.
And then AbernatheyHoldingsCo.com, our website.
Yeah, man, dude. Appreciate you taking the time today, and
thank you.
You're always inspiring to, I think, a bunch of young entrepreneurs, older entrepreneurs. Dude, you're doing big things. I'm excited to see what you do.
Appreciate it. I'm just learning and doing my best.
Yeah. Thanks, buddy.
Thank you.
Yeah.
Appreciate it.
See you.